Greetings, my name is Ted Hicks. I'm the Chief Investment Officer for Hicks & Associates Wealth Management. And today we want to talk about whether or not the bear is going to reawaken. As you know, bull markets are generally considered good. The stock market is rising. Generally speaking, bear markets are considered bad because the stock market is falling. And in particular, what we want to talk about is whether or not the bear market of 2022 is going to return. On the screen right now, we have the S&P 500, and what we really want to highlight here is this black line. We're going to zoom in just a little bit, and we want to highlight a couple of things. First, we want to highlight this level over here on the left. This is August 2022. The stock market was able to rally, and the stock market found resistance at this 200-day moving average. You can see I've drawn this black line over to the right-hand side. We'll come back to that in a second. The next level we want to talk about is this level right in here. This is the high from, I believe this is February 1st. And so what we want to discuss is this zone between approximately 4,200 on the S&P 500 and approximately 4,300. Again, these levels date back to prior highs that are significant. And as you can see, the stock market was able to rally well above this, but then it came back to test this level, rallied again, but was not able to make a new high. Whenever we come back and the stock market tests a prior level, that is considered a successful test if it holds and makes a new high. So it did hold, but it did not make a new high. And in fact, it then came down to test this 4,200 level. Now again, this black solid line is the 200-day moving average. Generally speaking, we do want to see a successful test of this. So the fact that we got this test is good. But what we want to see is the market moving strongly off of that test. And again, right now, the last couple weeks, we've been in this zone right here that where the bulls and the bears have been battling. Last week we rallied above this level, but we ended up closing the week right back into this zone. So one of the things that we're concerned about is we're concerned that this battle between these bulls and bears in this zone is not quite over yet. And in particular, you will recall that there has been a loud cry from economists all across this nation. The highest number of economists ever have been calling for a recession. They've been making that declaration for well more than a year now. And we have been skeptics for quite some time, however, but we are starting to see some chinks in the economy's armor. I'll show you one of them today. And so the point is, if the economists are right and that we are going to see a recession, well, that would suggest that the stock market could very well go back into a bear market, because historically the stock market does not bottom before a recession starts. That's the key. Historically speaking, the stock market does not bottom before a recession starts. So if all these economists are right, then it stands to reason that the stock market would fall back down. Now, one of the things that we have shown many times is this chart here. This again is the S&P 500, and it is showing you from 1965 to 1979. This is what is considered a secular bear market. And so again, from left to right, the stock market, yes, it did move higher, but it moved higher in a very violent fashion. And so you can see easily four bear markets, for what we would call cyclical bear markets within the secular bear market. But bottom line, this is a very challenging period. But what we want to zoom into, we want to highlight this area right here. So we're going to zoom in. Now we're looking at this section. This is 1973. You can see right here, January 10th, 1973, the stock market has a peak. And the stock market, the S&P 500, falls below. Now this red line is the 200-day moving average, falls below this line for the better part of 1973, but in October is able to rally and was not able to hold this 200-day moving average, and then ended up continuing the 1973 bear market, and the market did not finally bottom until October 1974. So this is a concern. The concern is that this is very similar. So imagine this is 2021. We got those highs And then 2022, we're below the 200-day line. We have been able to break back above it, but we are in the battle right now between bulls and bears right around this level of this 200-day moving average. And we have all these economists that are saying, hey, well, a recession is coming. Well, if they are finally right, then we would suggest that we might want to remember 1973 and 1974 because that bear market was really, really tough. So to give a little bit more clarity, during this time period, the S&P 500 fell about 16.5% down to this level. But then the market was able to rally. It rallied approximately 11%, only to then fall another 44% for a total decline of about 48%. That is incredibly detrimental and a very tough market. So this is one of the reasons why we remain on guard, because the stock market, as we have been describing in so many of our videos and so many of our blog posts and highlighted this in the research that we share with other advisors, the stock market has been very, very thin. There's only a handful of stocks that have really done well this year. And because the S&P 500 is cap weighted, meaning the biggest stocks have the most influence on that index's performance, these are warning signs. And so we need to see a character change in the stock market. I did say that I would show you one of the chinks in the economy's armor. Right now we're showing you Dr. Copper. This is the price of copper, and copper is sometimes referred to as Dr. Copper because it is often said that copper has a PhD in economics, because copper tends to fall as we go into recession. And on the right hand side of the screen, you can definitely see 2022, but it was able to rally. And it's been in this corrective mode right here, but you can see I've drawn this red line where recently the copper has fallen below that support level and has been putting in new lows. That is not a good sign. The last things that we'll mention is we'll talk about seasonality. If you've been watching our videos, and hopefully you find these helpful, and if you haven't subscribed, we hope you would hit that subscribe button for us, and feel free to share the videos with others. But last month we had a very tough month. This is a seasonality chart that shows the S&P 500's average performance from 1950 to 2023, and you can see that September 2023 was historically far worse than the average year. Now we reset this. It's the same data, it just I remove the 2023 performance for September, so the scaling changes. And what I want you to see is so far October is right in line with historical averages. Even though we have this seasonally strong period of October, November, December, January, that's not guaranteed to happen. And so again, this level that we've been discussing in the S&P 500, the battle between the bulls and bears is really, really important, and we will see how that transpires. If you're a client of ours, know that obviously there's nothing you need to do. We are taking care of this for you. If you are not a client of ours and you would like to learn a little bit more about how we actively manage money on our clients' behalf, by all means, feel free to reach out to us. You can find our information at hicks-associates.com. You can also email me directly. In the meantime, again, I hope you found these videos helpful, and we thank you for watching.